Hi there, Evan here with Crypto and Markets for Thursday, May 10th, 2018. Just wanted to go over a few quick articles here that caught my eye yesterday. This one was from Reuters. Sanctions spell the end of OPEC output deal. It's written by John Kemp. I definitely think it's worth a read. I will link it down below. However, my take on this, as much as I want to go ahead and believe John Kemp, I don't think this is the case. Secondarily, Nick Cunningham from oilprice.com wrote a great article on this last week. I'll link it down below, effectively talking about the Saudis needing $88 Brent to balance their books for this year. And then, of course, you have Venezuela, the most mismanaged oil sector in the world. They've put military people at key oil positions. See how that's worked out for them. Which then essentially lets OPEC carry on as if they have a higher compliance rate to the production cuts they agreed to in late 2016 than what's actually going on, which works to the Saudis' favor, of course. I went on a bit of a tweet storm about this yesterday myself as well. You can follow me at Crypto Markets too. I even retweeted a tweet there from Khalid Al-Fallah, the Saudi oil minister, probably butchered his name, I do apologize, talking about how they're going to work with other countries to mitigate the impact of that. Again, I think it's all talk. Anyhow, you know where I stand on the Iranian sanctions. A few 100,000 barrels a day comes off. Iraq makes up the difference, stays within the confines of the deal. There you go. Next one here. This is posted by Lisa Abramowitz on Twitter to a Financial Times article, which unfortunately is hid behind a paywall, when you can follow crypto markets for free and know we've been on this for the past year. China credit spreads hit their widest level in nearly 2 years as the government signals it'll tolerate defaults. Remember, the decline in the Chinese credit impulse. I've been on this since almost this channel started about a year ago, and we're turning out to be very, very right here. Again, did a massive ramp up in credit, which then led to the massive house gains they had in especially their first tier cities, Shanghai and Beijing, going into about early 2017 when that all started coming off. And again, half of these homes were bought up by quote-unquote speculators, remain empty, and a combination of two things. One, the banks started realizing they're having problems with people paying back those loans and had to pare back on giving out loans themselves. And then secondarily, the Chinese government started putting serious restrictions on buying real estate with Bitcoin, funneling money abroad, you name it. And where we start to see this, demand in industrial metals, as now they're not building nearly as many homes as before. They tried hiding this by putting all of their excess inventory that they had bought up for a bigger expansion. They kept hiding it all on ships. That's coming out now. Iron ore's peaked out. Copper's peaked out, which is a trade that's starting to work out for us now, by the way. Nickel had a massive ramp up in April. There was talk of the U.S. putting sanctions on a Russian nickel company, which then led to a lot of nickel being taken out of inventory. The sanctions never happened. That's come back down now. Aluminum really is the only one that's really stayed up, of the industrial metals at least. There was sanctions put on the Russian company Rusal. They've since impaired back. The aluminum price peaked out in about late April as well. But yes, because of this Chinese credit impulse, we are starting to see a lower demand now for industrial metals. And it is starting to show in a lot of the prices now. Lastly, this is on the Australian housing bubble from Zero Hedge. Australians face huge spike in repayments as interest-only home loans expire. Remember, I've told you about this. In fact, I did a video covering this topic roughly about a month ago, talking about how there was a lot of subprime loans slash interest only loans for the first 5 years, and then they were converted into regular mortgages afterwards. Well, to put this in context, in the previous article here, it was estimated that as much as 220,000 households could be in a situation where they're going to face a massive spike in payments, having to go from interest only to regular mortgage payments. Well, the Reserve Bank of Australia came out today and said that as many as 200,000 home loans every year for the next 3 years could face a $7,000 a year median payment increase. There you go. And the scary thing is, the Australian housing market in the first quarter is at the point where it's starting to tip over now. At a household debt to income ratio, it is a worse housing bubble than Canada. And I just don't see this ending well for them. I will link both articles down below if you do want to read them. I probably should be following the Australian housing bubble a little bit more in this channel. Again, I'm too busy with Canada because, in fact, I do live here. But yeah, on every metric, this looks way worse than Canada. I mean, this probably looks just as bad as a subprime crisis in the US, plus the Canadian housing bubble put together. Like, that's how bad this looks. Anyhow, I'll leave it here. Hit the like button, leave a comment down below, subscribe, and follow me on Twitter at CryptoMarkets2. Y'all have a good day.